Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi Dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Today we're going to break down an important concept that often creates confusion among Iraqi Dinar followers. The idea of the dinar returning to Forex, the discussion around re-pegging, the so-called program rate, and the belief that there could be two different rates at the same time. This topic requires careful explanation because misunderstandings can easily lead to unrealistic expectations. Our goal here is to analyze the mechanics in a factual, balanced, and economically sound way. Let's begin with the current framework. The Iraqi dinar is presently managed by the Central Bank of Iraq under a monetary policy structure that includes a managed exchange rate regime. Iraq currently maintains a peg to the US dollar. In simple terms, this means the dinar's exchange rate is anchored to the dollar, and the central bank intervenes to keep it within a defined range. The rate, commonly referred to as the program rate, is the official exchange rate set by the central bank and used domestically for government accounting, imports, and financial transactions. Now, there is frequent discussion within dinar circles about the dinar, going back to Forex. When people refer to Forex, they are typically talking about the global foreign exchange market, where currencies are traded freely based on supply and demand dynamics. It's important to clarify that even under a peg system, currencies can still be traded internationally. However, the degree of convertibility and flexibility depends heavily on domestic monetary policy, capital controls, and international financial integration. The key statement in the news paragraph is that when the dinar goes back to Forex, it will be re-pegged and off the sole peg to the dollar, and the program rate will go away. Let's unpack that carefully. First, re-pegging does not automatically mean a massive increase in value. A re-peg simply means adjusting the anchor of the currency. Iraq could, in theory, move from a sole dollar peg to a basket of currencies, similar to what some emerging markets have done. A basket peg typically includes major global currencies, such as the dollar, euro, or other key trading partners' currencies. This approach can reduce vulnerability to fluctuations in any single currency. Second, the claim that the program rate would go away reflects an important economic principle. A country can only have one official exchange rate at a time. While parallel markets can exist unofficially, from a legal and central banking standpoint, there is only one recognized rate. There is no formal structure in modern monetary systems where a currency has one country official rate and another completely different Forex official rate simultaneously. If Iraq were to fully liberalize and integrate into broader currency markets, the official rate inside the country would align with the rate recognized internationally. This is what the statement means when it says we are talking apples and oranges when comparing these two rate types. The so-called program rate and a potential future Forex rate are not two separate permanent systems coexisting. They represent different monetary frameworks. One is a managed peg system. The other would be a more open, market-aligned exchange rate system. Transitioning from one to the other means the official domestic rate changes to reflect the new structure. Now let's talk about the lower denominations. The paragraph mentions that newer lower denominations would have to be rolled out first. From a monetary logistics perspective, this makes sense. If a currency's exchange rate changes significantly, whether through revaluation, redenomination, or structural adjustment, the physical currency supply must support practical day-to-day transactions. Lower denominations allow pricing flexibility and smoother retail operations. Historically, countries that have adjusted their currency regimes often prepared the domestic market first. That preparation can include currency reforms, banking system upgrades, anti-money laundering compliance improvements, and modernization of payment systems. Iraq has already made progress in electronic payment expansion, banking reform discussions, and financial transparency initiatives. These are foundational steps for any country seeking deeper integration into global markets. However, it is essential to separate structural reform from speculative assumptions. A return to broader Forex participation does not guarantee a dramatic or overnight increase in the value of the dinar. Exchange rates are influenced by economic fundamentals, foreign reserves, GDP growth, oil revenues, fiscal discipline, political stability, and investor confidence. Iraq's economy remains heavily oil dependent. Oil exports provide the majority of government revenue and support foreign currency reserves. The strength of Iraq's reserves has, at times, been relatively solid compared to other developing economies. But long-term currency stability requires diversification beyond oil. It requires growth in manufacturing, agriculture, services, and private sector development. In the short term, if Iraq were to adjust its peg or move toward a basket-based system, the immediate implications would likely involve gradual recalibration rather than a sudden shock. Central banks typically avoid abrupt changes that could destabilize markets. A controlled transition would aim to maintain price stability and prevent inflationary pressures. Inflation control is crucial. If a currency strengthens too quickly without structural economic support, it can hurt exports and government revenue. If it weakens too quickly, it can drive up import costs and inflation. Iraq imports many consumer goods, so exchange rate stability directly affects the cost of living. In the long term, deeper integration into global currency markets could increase transparency and attract foreign investment. Investors prefer predictable monetary frameworks. If Iraq demonstrates strong governance, stable policy, and credible central bank independence, international capital flows may increase. That, in turn, can support currency stability over time. Another key point is the elimination of dual rate misconceptions. Some investors believe there could be a high international rate, while the domestic Iraqi rate remains low. From a financial systems perspective, that scenario is not realistic. Modern banking, digital transfers, and cross-border settlements make it nearly impossible to maintain two vastly different official rates without creating arbitrage opportunities that would destabilize the economy. Arbitrage occurs when traders exploit price differences between markets. If a currency had two official rates, investors would simply buy at the lower rate and sell at the higher one, creating unsustainable pressure. That is why unified exchange rate systems are essential for monetary stability. When the statement says that when the dinar goes back to Forex, the in-country rate will change to the Forex rate, it is emphasizing alignment. The domestic rate would reflect whatever the central bank and market determine under the new regime. There would not be two official tracks running simultaneously. For Iraqi dinar followers, what does this mean practically? In the short term, watch for structural reforms rather than rumors. Look for official announcements from the Central Bank of Iraq. Monitor foreign reserve reports, inflation data, and policy statements. Those indicators provide real clues about monetary direction. In the medium term, the rollout of lower denominations, modernization of banking systems, and enhanced compliance with international financial standards would signal readiness for broader integration. In the long term, the true driver of dinar strength will be Iraq's economic diversification, political stability, and fiscal responsibility. Currency value reflects national productivity and confidence, not just policy declarations. It's also important to maintain realistic expectations. Currency adjustments typically unfold gradually. Major economies plan transitions carefully to avoid shocks. While reforms can be positive, they are rarely instantaneous windfalls. A repegging away from a sole dollar anchor could provide flexibility and reduce external vulnerability. However, flexibility also introduces exposure to global market volatility. That means risk management becomes even more critical. For those following the Iraqi dinar, Focus on macroeconomic fundamentals rather than speculation. Sustainable currency strength requires strong institutions, transparent governance, and diversified revenue streams. In conclusion, the concept of the dinar returning to Forex and the program rate disappearing reflects a potential structural shift in monetary policy. It does not imply dual official rates or guaranteed sudden value changes. It means alignment of domestic and international exchange mechanisms under a unified system. As developments continue, we will analyze them carefully, responsibly, and factually so you can stay informed without hype or unrealistic expectations. If you value balanced and professional Iraqi Dinar analysis, make sure to subscribe to the channel and like the video so you never miss an update. And remember, this content is provided for informational purposes only and should not be considered financial advice. Always consult with a qualified financial professional before making any investment decisions.